If you're analyzing rental properties using the 1% rule or some free spreadsheet you found online, you're probably making decisions on bad data. I'm a CPA working in commercial real estate, and I built Ledger and Land because I was tired of seeing investors make expensive mistakes with broken calculators. Today, I'm going to show you how to actually analyze a rental property, the way professionals do it, using our complete analysis template. We'll look at a real $180,000 property, calculate every metric that matters, and decide if it's a buy or a pass. Let's dive in. Here's our property. Purchase price, $180,000. Monthly rent, $2,400, 20% down payment, $36,000, 7% interest rate, 30-year loan, $6,000 closing costs, $10,000 for repairs/updates. Total cash needed, $52,000. Quick check, does this pass the 1% rule? $2,400 rent divided by $180,000. Price equals 1.33%? Yes, it passes. But the 1% rule is just a screening tool. It tells you if it's worth looking closer. It doesn't tell you if it's actually a good investment. We need to go deeper. Let's calculate real monthly cash flow. Income side, monthly rent, $2,400, minus 5% vacancy equals $2,280 effective gross income. Why 5%? Because no property is rented 100% of the time. Even with great tenants, you'll have turnover. 5% is conservative for a strong market. Expense side, property tax, $2,000 per year equals $167 per month. Insurance, $1,000 per year equals $83 per month. HOA, $0, single family. Property management, 8% of rent equals $182 per month. Maintenance reserve, $100 per month. Other, $50 per month. Mortgage payment, $958 per month. Total monthly expenses, $1,540. Cash flow, $2,280 minus $1,540 equals $740 per month. That's $8,875 per year. Now, is that good? Let's look at the metrics that matter. Here are the numbers professional investors care about. 1. Cash on cash return. We put in $52,000 total. We're making $8,875 per year. That's a 17.1% return on our invested capital. Compare that to the S&P 500's historical 10%. We're beating the market by 7%. That's strong. 2. DSCR, debt service coverage ratio. This is what lenders care about most. Our net operating income before mortgage, $1,698 per month. Our mortgage payment, $958 per month. DSCR equals 1.77. Lenders want 1.25 minimum. We're at 1.77. This easily qualifies for financing. 3. Cap rate. This compares us to the market. NOI divided by purchase price equals 11.3%. In most markets, 6 to 10% is typical. We're at 11.3%. This is above market, a strong indicator. 4. GRM, gross rent, multiplier purchase price divided by annual rent equals 6.25. Lower is better. You're paying less per dollar of rent. Under 10 is generally good. We're at 6.25. Excellent. 5. 1% rule. We already checked 1.33%. Above 1% is the goal. We're crushing it. So far, this looks really good, but we're not done. We need to check taxes. Here's what most people miss. Taxes. You can deduct depreciation on rental properties. Our building value, excluding land, $144,000 divided by 27.5 years equals $5,236 per year depreciation. This is a phantom expense. You don't actually pay it, but it reduces your taxable income. Let's calculate our taxable income. Rental income, $28,800 per year. Less operating expenses, $16,565. Less depreciation, $5,236. Taxable income, $6,999. At 24% federal plus 5% state equals 29% total tax rate. We owe about $2,030 in taxes. After tax cash flow, $8,875 minus $2,030 equals $6,845 per year. After-tax return, 13.2%, still strong. Some properties show paper losses, and you save on taxes. This one doesn't. But it's still profitable after taxes. This is critical. I see investors all the time who forget about taxes and wonder why their returns aren't what they expected. Now let's look long term. What happens if you hold this for 10 years? Assumptions: 3% annual property appreciation, 2.5% annual rent growth. Property tax increases 2.5% per year. Insurance increases 3% per year. Maintenance increases 3% per year. Year 1. Property value, $180,000. Annual cash flow, $8,875. Year 5. Property value, $203,000. Annual cash flow, $10,929. Year 10. Property value, $235,000. Annual cash flow, $13,788. The ending loan balance after 10 years, $123,570. Your equity, $111,289, plus cumulative cash flow, $112,533, minus 6% selling costs, minus $14,000. Net proceeds, if you sold, $209,730. You put in $52,000. In 10 years, you could walk away with $209,000. That's a 4 times return. Not bad. But what if things change? Let's test scenarios. What if interest rates were different when you bought? The template automatically shows you plus or minus 1.5%. At 5.5%, COC return jumps to 20.3%. At 8.5%, COC return drops to 13.6%. What if you paid more or less? The template shows plus or minus $30,000. At $150,000, COC return jumps to 23.5% at $210,000. COC return drops to 12.0%. What if you can't get $2,400 rent? The template shows plus or minus $300. At $2,100, COC return drops to 11.0%. At $2,700, COC return jumps to 23.1%. This helps you negotiate. If the seller won't budge on price, show them what rent you need to make it work. All of this updates automatically based on your actual inputs. The template always centers on your numbers. So, is this a good investment? The scorecard. Positive cash flow, $740 per month. Strong COC return, 17.1%. Passes lender requirements, DSCR, 1.77 above market cap rate, 11.3% profitable after taxes, 13.2% strong 10-year projection, $209,000 net. This is what a strong deal looks like. Would I buy this property? Absolutely. But here's the thing. You can't just rely on back-of-envelope math. You need to run the actual numbers, including taxes, including long-term projections, including sensitivity scenarios. That's what separates professional investors from amateurs. If you want to analyze your own properties like this, I've put the exact template I just used in the description. It's called the Ledger and Land Rental Property Analysis Spreadsheet. Click the link in the description to download and use it yourself. Thanks for watching. If this helped, hit subscribe. I'll be posting more property analyses, market insights, and investor education. See you in the next one.